We have been very good over the years in calling market tops and bottoms, stock market I'm talking. And we think the downside in the stock market, it will likely be a typical bear market, meaning a very large percentage drop, but not sudden, no crashes. In fact, in the history of the United States, there's only one bear market, 1929 through 32, that began with a crash event. The other crashes we've seen, like in 87, when that ended, it was the bottom, it went up. March of 2020, we had a crash event, 35% in a matter of 3 weeks, and it turned up, okay? So crashes are not the normal for a bear market, so don't expect that. What bear markets usually do is they go down in slabs, and they give you rallies that tease you. So if you're a long-term stock investor and you're a believer in it, which we're not at this point, every time there's a rally, you get all heartened again. Everything's okay. You go look at the 2000 to 2002 bear market, all the way down, there were rallies that just look lovely. 2007 through 2009, same story. A lot of downside, but a lot of good rallies. Expect that, but expect downside. There's certain obvious fundamental reasons for this too, not just the technicals that we analyze. And that is, since 1959, every decade since, the money supply in the United States has almost doubled every decade, consistently. Regardless of policy moves by the Fed during that decade, it's almost always been a double in the money supply. If you look now, especially back to 2009, the last bear market low, when the Fed was panicked, everybody was panicked, the real world was panicked, it wasn't just stock market. They pumped the money supply up really good, and they cut interest rates to effectively zero. So a dozen years since 2009, interest rates have been on the floor, off reality, totally unreal. Money isn't free, but they made it free. So a lot of investors plowed that money somewhere. The big river flow, and they diverted it into what? The stock market. Stock market was the large beneficiary of it. And we argue that it created a stock market bubble. And again, we don't expect crashes. We expect a huge percentage drop over the next couple years. Probably the largest bear market we're ever going to see, because the stock market move we've seen since the 2009 low has been interrupted with some few sharp breaks. But basically, it's the biggest, oldest, and largest percent gain in the stock market in the history of the US stock market. It is a huge bubble. It makes the 2000 dot-com top look timid. It makes the 2007 real estate top look timid. So when it comes unwound, there'll be many wave effects, not just in other markets, but in people's lives. And we argued back in October of 2020, commodities were in the sewer. They'd been laying low for 5 years, from 2016 inclusive through 20. They were extremely depressed asset category. It was all the money the Fed was printing wasn't going into commodities. It was going into the stock market. As the stocks were making a bubble high, the commodities were like a beach ball submerged underwater for a long time. In October 2020, we called for a, quote, commodity explosion. And since October 2020, most commodities have exploded, and they've exploded in synchronicity. It's not like there was an excuse for wheat to go up, but not corn. They all went up. Most commodities exploded simultaneously, having nothing to do with the specific fundamentals of that market necessarily, but with a general asset flow into a cheap asset category. So large investors, guys like Ray Dalio, who's certainly not a gold bug, and there's others like him, have made statements over the last year of doubt about the sustainability of the pricing of the US stock market. They doubt the rationale. Ray Dalio made a statement. He says, quit looking at the price of your stock and pay attention to the underlying value of your money unit, because it's decaying rapidly. That's why prices are rising. A lot of these asset managers perceived the commodity category, including stocks that are related to this commodities, like oil producing stocks, agricultural related stocks, gold miners, etc., as better values, safer places to be than the normal stock market. So they started moving money over. And because those markets were so depressed for so long, when they started moving that money into these depressed asset category, they went up like the beach ball submerging above water level. Whoosh. Our assessment of the commodity category is that no, you're not going to top and go back down. I don't care what the Fed does or thinks they're doing. We've just begun an annual momentum uptrend in the commodity sector that just began a little over a year ago. Most annual momentum trends, when they shift, go for several years. We suspect expect that what we're going to continue to see is a rise in commodity prices. Basically, the real thing underneath it is the movement of the monetary excess, not just in the US, but in Europe and in Japan, into an asset category that is still relatively historically cheap. Most commodity markets like oil, which is now being blamed on the Russia event, Ukraine event, actually had exploded well before then. We put out a buy signal on oil at $40. By the time this event unfolded, crude oil had reached in the 80s. And then once the event hit, it shot up well over 100 again. Yes, you're going to see some commodity sell-offs here and there, but they're not going to be sell-offs that sustain. They're just going to be sideways ranges, but at a new high level. They're going to be at ranges that are very uncomfortable for the world economy. So the other game player here are the central banks. And we know what the Fed's trying to do. But he's going to, quote, fight inflation, meaning commodity inflation, which is how he defines it. Well, these guys dismiss, academically, they dismiss the stock price inflation. Monetary policy boosted stock prices off the page. They don't call that inflation. That's okay in their book. But now we have an event where stock prices are starting to drop, and they're starting to bother some people, and they should. The only issue is the nature of the decline, and there'll be zigzags. If you recall, the 2008-9 period did have some effects socially, not just the unemployment, but there was a lot of very hurt people, okay? This should be even more hurtful in terms of the social dynamics that come from it, things we can't even predict right now. Plus, at the same time, high commodity prices. You're basically left with the commodity category, and especially gold and gold-related. Asset managers and investors change their mind sometimes. Instead of favoring the categories the Fed wants them to favor, like muni bonds or high-yield corporate debt, which is also in collapse mode, or the stock market, they switch over to harder assets, especially harder assets that have been cheap for so long. And that game is not going to end soon. And as the stock market goes down, the Fed is trying to talk like they don't care about that. They've almost admitted that, well, even if we have recessionary effects, we've got to persist in this, quote, anti-inflationary policy. If that stock market gets a bit too low for them and the high yield corporate debt keeps breaking and commodities don't flinch, they're going to have a choice to make. They're going to have to support government debt, or they're going to have a disaster like they have created. They created the bubble. They're pricking the bubble themselves now. And once it comes unwound, my bet is you're going to see potential policy change back the other way. They can't afford to do that because if they do, their credibility's shot. Once people lose faith in the central bank, what then do they have faith in? And I'm going to argue that it's primarily going to be gold and related, and especially silver. And once that happens, the central banks will lose monopoly control over their money units, their fiat money units. If the public finally discovers that, hey, we don't need infinitely expandable fiat money to exchange with each other. We need something that's stable, that holds its value. And of course, gold does over time. We know that. And right now, we think silver is in a slingshot position to outpace gold even. So I think that's where the focus is going to be for the next year or so in terms of where do I put my money?